Friends, what is black money? What is this white money? Is it really ruining our economy? See, black money is such money that people keep hidden from the eyes of the government to avoid tax, which has no record. Money which has no record will not have to pay tax. And if the money is used without paying tax, then it will have a direct impact on the economy of the country. Friends, this is a shocking thing. In a country with a large population like India, only a small percentage of people file tax returns, and only a few of them actually pay income tax. Experts believe that 50% of the country's economy runs on black money. Corruption is also the biggest basis of black money in India. According to a 2012 report, Indians had deposited about Rs 9,000 crore in Swiss banks this year, and today it has become very much. There are many facts and reports that show how strong the roots of black money are. Friends, miles away from India, there is a small country in the west, Switzerland. It is said that Switzerland land is the world's happiest, where millions of people from all over the world come to visit every year. Switzerland is beautiful, nestled between high mountains and beautiful scenery. But along with beauty, Switzerland is very famous for one more thing, and that is black money. You must have heard many times that big people of many countries hide their black money in the banks of Switzerland. India's name is also included in these countries. It is said that many rich businessmen and politicians of India also hide their black money in Swiss banks, also known as Swiss banks. A common businessman has to pay about 25–30% tax to the government. If GST is also added to that tax, then it becomes about 48%. Now those whose earnings are less than 10 lakhs, they have no problem with this tax. But those businessmen and leaders whose earnings are in crores and billions of rupees, they do not agree to pay so much tax. For this reason, they do not tell the government about their earnings, or say that they hide their earnings figures from the government. By doing so, they get a chance to avoid paying tax on that income. Friends, after 2010, cases of black money started coming very high in India. After that, the government of the country changed and it was said to take strict steps against black money. The government also promised the public to bring back the black money lying in the banks of Switzerland. Friends, it is a bit difficult to understand the black money match. It is not as easy as it seems. To understand this, it is also important for you to know the answers to some questions, like how the Indian taxation system works. What is inflation? What is the Hawala system or money laundering? What is a grey list and a black list? Which countries are included in it? What is an extradition treaty? We are going to discuss all such questions in detail in this series, whose name is Decoding Black Money. In this, we will explain to you the whole concept of black money well and explain it easily. Not only this, you will also be able to easily understand the impact of reading on the economy of our country. Apart from this, we will also be able to understand the tax system in India, cryptocurrency, and we will also talk about ways to get rid of problems like black money. So join us in this wonderful journey. The money that people steal in the tax charged by the government is called black money. We all know this, but before talking about black money, it is very important for us to understand the entire system of tax. Because without understanding it, it becomes very difficult to understand the concept of black money. Tax simply means that the government gives us all the other types of facilities related to roads, railways, and healthcare. In return, the government has to take some money from the public to run those facilities. Because the government does not have any money of its own, nor can the government give facilities to the public by pressing money at will. Or when you are driving your car on the road or going somewhere by sitting in the train, then the cost of building that railway and the cost of building and maintaining that road is deducted from your own money. The tax that the government takes from you for these works is used only for the welfare of the people, not for filling the pockets of the government. Therefore, it is the responsibility of every citizen of the country to pay his share of tax honestly. But here the question arises that how much is the tax of every citizen's share and how much money a person has to pay to the government every year? To know the answer to this question, we need to understand the tax system implemented in India. You must have often read in the newspapers that the government of India has announced the date for filing income tax returns. This is the income tax. The money that is saved by not paying it is called black money. But this income tax is not collected from every citizen of the country. Because there are lakhs of people in our country who do not have enough income to pay anything to the government. Therefore, the government does not take the same tax from every citizen of the country. Rather, tax is taken from them according to their income. In this way, the government does not take any tax from the one whose income is low. First of all, let's know who has to pay the tax. The government does not charge any income tax from the citizen of our country whose annual income is less than D-high lakh rupees. Because the annual income of D-high lakh rupee means that that person earns about 21,000 rupees every month, and he runs all the expenses of his household with them. Even if someone has to pay tax with such a small income, then he will not have anything left to eat. In view of this, no income tax is levied in our country on annual income less than 2.5 lakh rupees. But citizens whose annual income is between 2 lakh rupees to 5 lakh rupees are collected as income tax every year. For example, if a citizen's income for the whole year is 3 lakh rupees, then he will be taxed 5% of 3 logs in a year, i.e., 15,000 rupees. On the other hand, if a citizen's income is between 5 lakh rupees to 7 lakh 50,000 rupees in the whole year, then 10% tax is collected on his income every year. This system of taking different taxes is called tax slab. According to the income department, in this tax slab, citizens whose annual income is between 7 lakh 50,000 rupees and 10 lakh rupees, 15% tax is charged on their income. At the same time, those whose income is between 10 lakh to 12 lakh 50,000 rupees, 20% tax is charged. Similarly, the citizens whose income is 12 to 50,000 rupees is 15 lakh rupees. They are taxed at 25%, and finally 30% from those citizens of the country whose annual income is more than Rs 15 lakh. Apart from income tax, the government of India collects another tax from the citizens of the country, which is called Goods and Services Tax, or GST in short form. The GST system was implemented in India in the year 2017. Earlier, VAT, i.e., Value Added Tax, was levied in India. The meaning of these two taxes is that whenever you buy a product or take the service of something, you will pay tax to the government for it. If you remember, earlier whenever you used to buy an item at your house, you would also see VAT on the fixed bill received with it. So if you see that some percentage VAT will also be added to the price of the fridge in his bill, the price of the fridge that has been charged from you remains with the shopkeeper, but the extra VAT you have given on it goes directly to the government. What we mean to say is that before GST, the value added tax that was levied on every item at a different rate, i.e., rate. That is, maybe 5% on the fridge, 10% on the fan, or 15% tax should be levied on laptops. But in the year 2017, this system was abolished and a system called Goods and Service Tax was introduced, in which the same tax was imposed on the same item. That is, all the items of electronics under GST will be taxed at the same rate. Similarly, there are other services which are kept in the same category. The same tax is levied on them too. That is to say, different categories of goods and services have been created in GST. The entire category of goods that falls under the category is taxed at the same rate. In this way, a total of 5 different categories of GST have been created. The first category includes some essential things like grains, salt, jaggery, and fresh vegetables, without which no person can function. The government does not charge any kind of GST on these things. The second category includes sugar, oil, spices and tea, and things like coffee, on which 5% GST is charged. That is, if tea leaves are available at Rs 200 per kg in the market, then 5% of Rs 200, i.e., Rs 10 GST will have to be paid on it. Similarly, 12%, 18%. And different categories have also been created for the goods coming under 28% GST. So far, we have tried to understand the entire system of GST and income tax. In this way, you must have understood this too.